Hi and welcome. My name is Anita Rehome and I am the financial literacy coach for St. Philip's College. And we're going to be talking about the lowdown on entrance counseling. So for those of you who have already taken out a student loan, you've already completed entrance counseling. And you're probably could have, like I did when I took out my student loans, have already forgot exactly what entrance counseling did for me and what information it was trying to provide to me. If you're considering taking out a student loan, this is kind of a brief, what I feel is very important to re-explain to you as a student taking out a student loan of what I feel is very important. And so if you're considering taking out a student loan, you still have to complete entrance counseling. If you've already taken out the student loan, you've already completed entrance counseling. So this information is not intended to replace the completion of entrance counseling. So if you're still considering, you guys, you still need to complete entrance counseling that is designated to you by the Department of Education to even receive your loan amount. If you're considering taking out a student loan, you are required to complete the entrance counseling. So please make sure that you complete that if that's something that you're wanting to do. So you're probably wondering, what am I going to be learning in entrance counseling? There is a whole lot of different material that you're going to be learning. I feel this is a breakdown of what I feel is very important for you to be readdressed, to be reintegrated into the importance of taking on a student loan and what these things mean. So we're going to be learning about the promissory note. You're going to be learning about subsidized versus unsubsidized. You're going to be learning about the annual amounts that you can take out as a student, the repayment and capitalization, deferment versus forbearance versus default. These things are very important because we want to make sure that you understand this obligation of you taking out the student loan, how much you can take out. Do I need to take out the max amount? Can I just take out what I owe? Which I will always recommend. If you only owe $1,000 to the school, only take out $1,000. If you are struggling financially and not sure that you're going to have enough for books, take out maybe $1,500 versus $1,000. Just so you have enough to cover those books. But you guys don't take out the max amount. So we're gonna dive right into this, okay? So the first thing we're gonna be talking about is master promissory note, okay? So the master promissory note is something that you have to sign, right? It's an electronic signature. You're gonna be reading what the master promissory note is in your entrance counseling. You are going to be finding more detailed information about the terms and the conditions of your loans in the borrower's rights and responsibility statement, which is the BRR. And that also accompanies with the master promissory note, which is also known as the MPN. This document is important because you're not eligible to receive any funds unless you've signed it. So they will take your electronic signature as you complying. You understand what the promissory note is. And basically it's a promise to repay back the student loan. You have up to 10 years, which is the standard repayment plan that everybody gets into. Now, there are different repayment options that we'll get into later that are income-based. But again, you have the 10 years, which is the standard repayment plan to repay back your student loan. So imagine if you're taking out, $50,000 in student loans, you're basically promising to pay that back in 10 years. Is that something that you can afford, right? It does contain specific details and terms about your loan, so you want to make sure that you always keep a copy of that. Now we're going to get into subsidized versus unsubsidized student loans. And you're probably thinking, well, I know what that means. So again, the promissory note, it talks about specific details about the loan that you're taking, the direct loan. So you're going to receive a disclosure statement that provides specific information about each loan, including the loan amount, loan fees, and the expected disbursement dates and amounts. And you're probably wondering, okay, what's a loan fee? I've never heard of a loan fee. So basically, if you're taking out $5,000, automatically there's a percentage that comes off of that $5,000 that's considered a loan fee. It's usually about like 5% of it, but you're not taking out a full $5,000. You're actually going to be dispersed less than that once they take the fee off of it. And then obviously minus the cost of your schooling, then you'll get that refunded to you. Your disclosure statement can keep track of what you're borrowing. It'll also let you know whether the loan is unsubsidized or subsidized. So think of subsidized as super, right? So any undergraduate student is going to be approved if there's a financial need for a subsidized loan. And basically what subsidized is, it's a need-based, and generally the government pays for the interest while you're in school and during deferment periods for subsidized loans. So basically Deferment means like you're in an in-school deferment. That means the government's going to pay for your interest rate or your interest fees while you're in school. Now, an unsubsidized loans are not on a need base. So, right, you're going to be approved for a certain amount when it comes to subsidized. You're going to be approved for a certain amount when it comes to unsubsidized. But unsubsidized loans, you are responsible for the interest accrued during all periods. So it's very important that you understand that. Subsidized, government pays for the interest. Unsubsidized, the interest is something that you're going to have to pay for, that you are paying for out of pocket. Again, you don't have to pay for it during your term while you're in school, but all of that will be added / capitalized towards the end of your loan. So if you took out $5,000 in a student loan, right, and even though you only got like $4,500 out of that in a check, you still promise to pay $5,000 back. Now it's up to you. The responsible thing to do is to pay that interest while you're in school. But if you don't, all of that interest, let's say you get an additional $2,000 in interest, all of that capitalized. So they're taking that $2,000 and they're adding it to the $5,000. So now you owe $7,000. Now you're probably thinking, Miss Rehome, that's not a lot of interest. That's not bad, but let's think about it. You're taking out a student loan right now that's for your associates, and you're taking out, let's say, $2,000 for the fall, $2,000 for the spring, and it takes you 3 years. So 3 times 2,000, 3 years, right? So that's 2 semesters. That's $2,000 a year. So that's what, $6,000. All of that interest adds up, right? So let's say it's, $1,000 each, but then you're going to go get your bachelor's. And then, so all that interest is still accruing, and then you're going to get a master's, and then you're possibly a PhD. So think about that. Think about how long you're going to be in school and how long you're not going to be paying interest and how much that interest is going to be tacked on till the end. So it's very important that you understand that. The next thing we're going to be talking about is direct student loans and the annual amounts. So for the first year undergraduate, like we talked about, for dependent students, it's $5,500. For independent, it's $9,500. So it's telling you no more than $3,500 can be subsidized loans. Okay. It breaks it down for every year. It increases, and then it obviously increases for subsidized loans, no more than $4,500, no more than $5,500. So even though a school says, all right, Anita, you have been awarded $10,500 in student loans, do you want to accept that? I can accept that, but do I want to accept that $10,500 and be responsible? Granted, that amount sounds really great to be in my bank account, but it's still a loan and I still have to pay on it. So what is that monthly payment going to be for me, right? Can that be something that I afford? What if I only get an associate's degree and I'm taking out $10,500 each semester? Now that comes out to $21,000. Can I afford a $21,000 loan? That's almost a car payment, roughly, with my credit, the way that it is. What is my interest going to be? Granted, student loans don't go off credit reports, but think of it like that. Like if I'm getting a car and I'm paying $21,000 for the car and I have to make monthly payments, I'm looking at maybe a $400 payment a month. Can I afford that with the type of job that I'm going to get? So it's very important. There is a limit that the max you can take out as a student borrower, but let's just be sure that you only take out what you need a month. Even for dependent undergraduates and professional, look at the amount, $138,500. So it's you guys, again, it sounds really great, but that's a mortgage almost. So let's be mindful when taking out student loans and that you only take out what you need. Okay. The next thing that we're going to be talking about is the capitalization. Now, again, right, subsidized loans, the government pays for the interest. Subsidized loans is going to be that you pay for that. So the first thing we're going to be talking about is repayment. You have a grace period for both subsidized and unsubsidized loans. It's for 6 months. Okay, so it doesn't matter if you received your degree or you didn't. If you stop going to school or drop below half-time, so if you graduate with draw or drop below half-time, you start going into your grace period. So let's say I get a loan out for the fall and it's $5,000. And then I decide, you know what, I'm going to go ahead and take the spring off. And I don't start again until the fall again, right? So we have January, February, March, April, May, June. By July, I'm going to be going into repayment status. So I already have to make a payment, but then I start again in August. So you make the payment for the 1 month, you start again, you go back into deferment status, in-school deferment, right? But once I graduate, I have to start making payments because I already used my 6-month grace period when I took off in the spring. Do you see how that works? So it's very important that you understand that if you stop going to school and you have a student loan, you have to go into, you start using your grace period. So you need to be very aware of that, okay? There's also the different repayment plans. There's standard, graduated, extended, income-driven plans. There's income-based repayment, income contingent, pay as you earn, revised, pay as you earn. So those are very important that you understand the obligation of those. Okay, so again, once you graduate, you do your 6-month grace period. The standard repayment plan is the default plan that every student gets put into. You pay it off in 10 years. It's usually less in interest when I say, since you're paying it off in 10 years, you're not adding all that interest on as you would with a graduated, extended, or income, because right, every month, just like a credit card, interest gets added. So yes, you're paying a payment, but interest continues to be added. So if you want to apply for an income-driven plan, you have to apply for those yearly and submit paperwork for that. So if you miss that yearly paperwork timeframe, more than likely you cannot reapply to get into that program. So you have to be very aware, very organized when it comes to repayment. Then there's capitalization. You have the option to pay interest while you're in school, again, for unsubsidized loans. Because when they're subsidized, the government is paying for that. But once you graduate, drop below part-time, and withdraw, you start using that grace period, and then interest starts getting added onto it. So with a subsidized loan, eventually after, you're going to start getting charged interest. The loan enters repayment when deferment ends and when forbearance ends. So again, if you have $2,000 in interest that you haven't paid while you were in school, that's going to be added to the total amount to the end of your loan. So it's very important that you understand, again, I keep saying it's very important that you understand, this is a huge obligation. These are things that you really need to consider when taking out a student loan, and understand the verbiage when it comes to a student loan, because it can be very hard to navigate. When it comes to having to repay back and that capitalization, obviously, if you pay more to your principal when possible, that would be great. Your principal would be the $5,000, the interest would be $2,000. So if your payment is $100, you definitely want to try to pay more towards your principal, because the sooner you pay down that principal, then eventually the interest will not be added on. So deferment versus forbearance versus default. So these three words are very, 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 very important when it comes to student loans. So you need to consider that at some point, right, there is deferment, forbearance, and default. Okay, so deferment allows you to postpone payments under certain circumstances, such as returning to school, unemployment, or military service. So there are some loopholes when it comes to being in deferment. That means that the government's going to pay for your interest if you have a subsidized loan. Forbearance is generally a more costly option, but it is often considered as a last resort, because with forbearance, the federal government does not pay for the interest on your loans, but you need to make sure, if this is something that you're considering, talk to your loan provider, your service loan provider, and be like, can I do forbearance first, since it's the better option for me? With forbearance, it temporarily reduces you making payments, but again, interest is going to accrue. If you go into default, that means that you haven't made payments for 270 days. So there can come a bunch of consequences when you default, when you don't make payments, right? So here we have negative credit report, difficulty getting hired, federal tax refund withheld, unable to renew professional licenses. Like if you're an RN, a real estate agent, you can get your wages garnished. Those are to name a few, right? And so it can be very difficult, especially if you are going to be applying for a job where they need to check your credit, and then they see that you are in collection status with your student loans. So it can affect you later on in life. So it's very important that you understand those obligations. If y'all have any questions when it comes to entrance counseling or wanting to learn more information about it, please don't hesitate to reach out to me. My name is Anita Rehome again. My email is erehome@alamo.edu. And my phone number is 210-486-2140. You can contact me at any time. It's most convenient for you. Y'all have a great day and good luck this semester. Thank you.